Good evening. I'm
Hi, hi,
David
hi.
from SIAS. I'll be moderating tonight. Welcome to Market Outlook 2021. It is only slightly year ago when Singapore reported its first confirmed case of then known as Wuhan pneumonia. Little did we know that COVID-19, as how we know it now, has evolved into a global pandemic, and from a health crisis to one with economic and social ramifications. 1 year into the pandemic, it is now a good time to take stock of what has happened in the market, reflect upon the learning points, and prepare ourselves for what is to come. I'm sure these are teething concerns you have as investors. And I have with me three investment experts to lend their insights on issues that matters to you this evening. Firstly, the famous Mr. Song Seng-woon, who is a well-known economist, much sought after, a regular media personality. He is one who comments on the economy situations, the developments in the economies, not only in Singapore, but around the region. I have with me, secondly, an expert on property, Mr. Mohammad Ismail Ghafoor. You all know him, just like Song Seng-woon. He is also a media personality, and his views are well sought after as well. He is the executive chair and CEO of Propnex. Oh yes, Song Seng-woon is an economist from CIMB Private Bank. And tonight we will hear from Mohammed his views on where the property market is heading. Well, thirdly, Mr. Benjamin Go, who is from my association as well. He's the head of research, SIAS. Benjamin is currently also senior lecturer at the Singapore Institute of Technology. He's also coming tonight with tremendous experience and in finance and a variety of finance courses he conducts at the university. He's an adjunct instructor with CFA Singapore, and his specialty is equity analysis, portfolio management, and economics. Well, gentlemen, we have had the elections, the much awaited result. Biden is in the chair. All right. So we are thinking, how is it going to be like? We know what it was the last 4 years with Trump. The markets didn't do badly. They did quite well, if not for the COVID, pandemic. So let's talk about the impact of the change of leadership in US and on the markets, not only in Singapore, but around the region and even the world. Because, US, Europe affects our markets, and China as well. So one of the top concerns for investors is, how is it going to be? Is it going to be a good, bull run, or is it going to be bearish market? The Democrats have now promised to spend about 2 to 3 trillion on additional economics stimulus and focus on infrastructure and green energy. But despite the economic impact of the coronavirus, US markets ended 2020 with robust gains, Songwon, right? And Benjamin. So basically, what does the new political landscape mean for investors? What are some policies which investors can expect from Biden that would impact emerging and Asian economies? Over to you, Songwon.
Okay, just get the ball rolling. I
Yes.
suppose after the tremendous brutal period under the previous administration, there were plenty of hope. New dawn. Hopefully, less pronouncement through tweaks, not tweak storm. I suppose bottom line really is just a wish and hope for less confrontational, I suppose, politics, and I suppose the wish list goes on, which is why I think we had that tremendous sigh of relief after the election in presidential election in November, and added sort of a relief after the two seats went over in the Georgia election. So there is that expectation of blue skies and everything nice, but obviously I still believe that
Yes.
the long shadow of former President Trump will continue to cast a long shadow over US and global politics. But for now, I suppose we can just say, do a sigh of relief, hope that there will be more supportive policies from the fiscal side of the US government, complementing that with still very accommodative policies from the US Central Bank. And tonight we'll hear from Fed Chair after the I suppose first Fed meeting of the year, to see how they continue to be supportive, etc. as well. So I think again it's just a case of fingers crossed for a more hopeful start of a new growth cycle after the pandemic triggered the end of the very long matured growth cycle. I'm not sure whether Ben has more things to add on to that.
So get rid of the pandemic, handshakes with Xi Jinping, all right, and get the Europe going, get China going, let America get back on even here. Is that right, Benjamin? What's your wish list?
Well, I think a couple of things. I think the Trump administration has obviously been very good for capital markets in the US, simply because the Republicans are known for deregulation. And, Trump has pulled back within his 4 years quite a lot of the policies that were implemented by Obama. So now that we have a new Democrat president, and already in his first week, he has reversed quite a lot of policies, and he's already canceled the Keystone oil pipeline from Canada, and also has banned new oil projects in Alaska. You can see where this is going, right? So I guess the challenge here is that under a Democrat president, typically there's going to be a lot more red tape and focus on civil rights and labor issues. So the capital markets may not do so well. But on the flip side, as Mr. Song has alluded to, there's going to be an unprecedented amount of stimulus, fiscal policies, or a fiscal stimulus package, as well as near zero interest rates. And of course, all of us here are old enough to remember 12 years ago when we had close to zero interest rates. It was basically party all the time in the S&P 500, simply because people can borrow things very cheaply, and then they use it to punt in the capital markets. So I think I am also looking forward to that, to see how that plays out in the capital markets. And the last thing is, of course, the geopolitics. I think it's actually quite difficult for President Biden to climb down from all the adversarial rhetoric that Trump embarked on without losing too much face. So I think that is going to take time for that to normalize.
So
I think the key thing really is about getting the pandemic under control in the US side first. Yeah,
pandemic under control, and then they got to inch their way towards where they were, pre-Trump with China. And also they got to make sure that internal politics, the current upheaval is solved. There is an upheaval,
Yeah, it will be. I mean, not so easy to roll back on the anti-China rhetorics when you have push it down so far. So I suppose these are the risks that still are going to be with us over the near, which is why I'll talk about the long shadow of the Trump policies to stay. But certainly, I think certainly for now, as far as markets concerned, it is stimulus euphoria. Yes, there may be some doubts about the current pandemic itself, but a supportive, sort of almost central bank acting as lender of last resort, continue to be supportive of market condition. But as Benjamin says, we are quite wary, but maybe because we are just too old, but never mind.
Well, Mohammed, Singaporeans all have property, a roof over their head. This is a government policy. Everyone has a roof over their head. Now we are in property. Now, how comfortable are you with the new regime? You think things will turn around better for the property market? There has been a flurry of activities in the Singapore market. And how optimistic are you that we will be having a bull run?
I think Benjamin had said something about interest rates being very attractive. Despite the COVID situation, the pandemic, or for that matter, change of regime, Singapore seems to have some really special attributes that attract people, because we have to see that Singapore is situated within the surrounding of Asia. We are talking about 1 billion overpopulation of the China, and as well as 1 billion population of the India, the Indonesia. I mean, we are really in a place to enjoy something that sometimes it defy odds to an extent. But I'm not saying that the global crash or economy will have not an impact, but it has been proven last year specifically, where the new launches outperformed 2019 in terms of volume of transactions. The resale market 2020 outperformed 2019 by 19.9% just purely by volume of transactions. That's the point that I'm trying to say. What am I trying to say here is people are looking at it the other aspect, the positive sentiment with a low interest rate that is being available. And to a fair extent, today's sellers are a little bit more sensitive to the pricing, and people come in a confident way. And what was interesting, I must say here, is this: 82% of all the buyers last year were Singaporeans. That's one of the very highest percentage in recent time.
Yes.
And in fact, the foreigners numbers dropped to 3.5%, which was one of the lowest in the last 10 years. So what am I trying to say again here is this: the domestic demand has been very positive, Singaporean coming into the market, and generally the market is expected to remain resilient. And we just witnessed that in January for the first 2 weeks. Number one, Normanton Park just sold 600 units in one weekend, setting the highest number on a launch weekend in the last 7 years with such a background. So I still think the market will be positive in terms of the demand and as well as the price for this year.
The big
I must jump in at this point, if you don't mind. In terms of, I must say that within Singapore, because we had been able to support the economy in terms of the local jobs market, yes, or the overall labor market condition has weakened, and indeed it is, unemployment rate at the decade high. But I think overall we haven't had that kind of very severe stress on the local labor market that would be typical of a very bad recession. Obviously, we knew that rates were low and government policies were rolled out, debt moratorium, etc., to help both businesses and households. So that has been very, very supportive, I think, on the demand side. And because of the low interest rate environment and because of the support, I think it has certainly helped. I think Mama is right in saying that gives confidence. Remember, it's all about confidence to spend, and property is lumpy items. So if you can be confident about jobs, it's confident about income, you are confident about then committing, because again, we just finished with a recession, a long tail end of a long growth cycle. Recession, start of a new growth cycle. So typically start of a new cycle, you got excitement, building in. My only thing I think must add today is that we also don't want to be over excited as well, because as we've been seeing, because of the huge amount of interest, and even the government policymakers are also wary that we do not want a start of a very strong, robust upcycle on the property side that outstrip the fundamental. So I think we just need to be careful that we don't want to be, in that sense, getting too excited and pushing the fundamentals when in the property market, when the underlying macro condition is still, we are on the start of a new growth cycle, but it is somewhat wobbly at this point in time. So I think that's really something that we have to be careful of.
Right. Mohammed, government has come out with announcements, 2 ministers at least, keeping a close watch on the property market. All right. Does it send shivers down your spine?
Not on my side. But I think I do hear what Mr. Song said, and I think what is the close watch. These are all reality check that is necessary.
Yes.
I totally agree to the fact that one have to look at the fundamentals
Yes.
for committing, because it is long term. But one of the key things that I would like to highlight here is why are we in such a strong position right now
Yes.
next to the government?
Right.
Because of the various cooling measures that have been put in place since 2011-12-13, such as
Yes.
total debt servicing ratio,
Yes.
additional buyer's stamp duty on the second purchase and the third purchase. And that's why what we have literally, to a huge extent, eradicated are speculators. In
Right.
the previous cycle of the global financial crisis or the previous SARS, you see the prices tend to go down and up in a much more cyclical. But in this time, why it did not happen simply is because of the respective cooling measures. Today's buyers are not speculators. They are coming with the mid and the long term. These are the buyers who have the ability, because first and foremost, any buyer who buy, they can't sell within 3 years because of seller's stamp duty.
Yes.
And there is some kind of a check and balance here. And I still agree to Mr. Song and anyone, you should not be speculative and you should be measured in your approach, knowing your own job employability and your finance status.
Well said. Well said. Thank you. Let us look at STI's performance in 2020. After peaking at 3,280 in January 2020, it came down to 2,840 plus. Can we expect, in fact, the total STI closed with a negative, all right, minus 8% or so. So, which may seem reasonable with the occurrence of an unprecedented event like COVID. One would expect that. But if you really analyze it carefully, it reveals a relatively different and lackluster story, right, Benjamin? As Hang Seng Index, Nikkei, and S&P 500, they all were positive. 18.2, 18.4, of course, Hang Seng was minus 0.2. But Singapore, STI closed lower for the third straight day even now. And it ranks highly in managing COVID. We are doing very well. What then are the reasons for the relative underperformance in 2020? And is this likely to show its head in 2021?
Okay. I guess it's a good time to take note that the analyst consensus is for the STI index to end the year 2021 at between 3,000 to 3,200 points. I think the analyst from CIMB is calling it at 3,050 or something, right? Mr. Song, can't quite remember. But as you can see, this is pretty much a reversion to the mean. So prior to the pandemic, the pre-COVID-19 levels for the STI index were hovering within a range of between 3,000 and 3,200 points. If you take a look at the what has been pushing the S&P 500 up over the 2020, it was really the sector rotation into the technology stocks, simply because people kind of discovered that if you're locked up at home, then you're gonna have to buy a lot of stuff from Amazon, or you're gonna kill time watching Netflix. So those kind of companies have done very well. Yeah, I mean, I'm a customer of Netflix and I spend an obscene amount of time on it. Just FYI.
I suppose just to add on to Benjamin's point, I mean,
Yes.
if we were to look back, it could have been worse. I mean, at the end of October, beginning of November, Singapore STI was down like 25%. Just
Yes.
shared behind Thailand, we was down like 26%, but we did a sort of rolling rebound on the back of the Biden victory, on the assumption that stimulus will be helping, the so-called reflation trade, etc., which lifted the banks and obviously the developer. So for Singapore, I suppose we really don't have the kind of what you're talking about earlier in terms of those modern manufacturing, modern services that would have been able to lift the Singapore market, which was obviously, if you look at the STI, it was banks, developers, the conglomerate side, more old school, shall we say, although the banks will certainly argue that they are digital banking, which I think is the case. So we have to see, I suppose, at this point onward, if we are indeed on we are at the start, I must emphasize, of a new growth cycle. But obviously the key difference this time around with this cycle is very uneven start, and we don't even know how long will it really take off, because the pandemic is still creating chaos around the world. But inevitably, find it will. Lawrence Wong say we could be dealing with this for 4 or 5 years, but never mind. If it is 4 to 5 years, it is still the start of a new growth cycle, and all economy stock can still redefine and reimagine themselves. So yeah, which is why we had the CGS-CIMB forecast being a little bit more conservative in that if we are not chasing, say, DBS or some of the bank stock, back in October, you will be pushing it a little bit to chase them now, because we say, okay, what has fundamentally changed? The world is a better place, but okay, are they borrowing more? Are they lending more? Are we seeing huge investment flow? So all these things I would say are now going to be settled at a new range, just like US dollar, just like interest rate. I think their adjustment and reset now is a reset at the new range, perhaps, awaiting for new catalysts. I mean, we don't have the kind of technology play, the new service provider that would get investors excited back home. There are plenty abroad, outside, whether it's in Hong Kong or obviously in Europe or in the US side. But I suppose the SGX is working hard to make sure that we do have some more sexier story to come along, I suppose.
Yeah, I think it's certainly right that the Singapore capital markets, the various sectors have not been doing very well for the lack of catalysts. For example, you have the bellwether offshore and marine, as well as transportation, right? So these are really heavily badly hit by the fall in energy prices, as well as the restrictions over travel. So I think certainly agree with Mr. Song that this kind of sectors will probably have a new normal, and they may take more or extended time to be able to revert back to what they were pre-COVID-19 pandemic.
Yes. So, Mohammed, are we expecting more property launches as the economy recovers? Are you optimistic there will be more launches coming in? What would be some of the more interesting projects to look out for? And what would you advise, be for potential buyers?
I think, yes, in fact, start of this year, there were every singular week, there was one project being lined up. I may not want to really give any specific recommendation of what project to look at. I also want to be fair on that. But I want to just highlight some of the areas to really look out for. When we look at the prices for last year, as far as Singapore real estate market is concerned, we should look at regions, not by a project base. And what do we mean by regions? The URA track the price indexes of the core central region, being the district 9, 10, 11, and the financial centers, which is the core downtown core business district. This is known as core central. Then we have the rest of the core central region, which is the outskirts of the core that goes to anything between Balestier to Eunos to Marine Parade, Whampoa, just the outskirts. Then eventually will be the outlying areas, which is outside this area. Why do I say that here? Is what we have noticed here is the price increment of the outside the core central region has been very strong. What is being really fueled a fair amount of demand is actually HDB upgraders are playing a huge catalyst in the demand for the private property market. This is mainly because just this year alone, we will have 25,000 HDB owners attaining the MOP of 5 years, and next year will be 30,000 HDB owners minimum occupation period. And these are the people, when they sell, it's quite common to even hear $1 million HDB or 700,000-800,000, and they are all trying to have a better lifestyle. So generally speaking, it's a good time to look at property in the core central region because the price is a bit depressed. Mainly because in the absence of overseas buyers coming to pick up, so developers aren't able to price high. But you must really work out your sums. And obviously, the rest of the core, the outskirts of the thing also have gotten a very good value proposition. Some of the recent launches that have done really well, not a specific project, was like Clavon was launched in December. Developers sold 75% by UOL. And that's an amazing story, right? In one Saturday, you can sell 400 over units, 75%, and that is at Clementi. Normanton Park, another rest of cost central product, just launched last weekend, sold 600 units.
All
so these are
Singaporean.
some of the things that take a lot of positive traction.
All local Singaporeans buying.
90% over are Singaporeans.
But Mohammed, let me point this out to you. The apartment sizes are getting smaller and smaller. And I often hear young couples telling, look, it's very small, but we pay a lot of money for, condominiums and flats. There has been a substantial media scrutiny in Hong Kong on the rise of nano apartments. You know that, right?
Yeah.
And it is hard to imagine apartments being that small in Singapore, but the size of apartments in Singapore have indeed shrunk.
Yeah.
So are we getting value for money in there? So, young people are wondering, I remember when I bought my first house, it was only, 98,000 with landed property. Today, 98,000 won't buy you a room, right?
Those are the good days, Mr. Gerald.
Those are the good old days, we were lucky.
5 cents can buy you a lunch, like that.
Yes. Do you think that this trend will continue, Mohammed? Because are there still areas in Singapore where you can get a relatively good size apartment at a reasonable price in the secondary market?
Yeah, I definitely say yes, we could, because you qualified by saying a secondary market.
Yes.
It is for a similar budget, one would be able to buy a slightly bigger house in the resale secondary market versus for the same budget, a brand new house. The brand new houses are priced per square foot much higher because the developers have committed a higher land bid prices. So it will have to cascade down. But one of the interesting thing here is this: we are really fortunate as Singaporeans because the government step in and put their hands and their nose, and as exactly we heard it, two ministers say we are taking a very vigilant look. So what I meant by that here is this: developers don't have even the ability to size it totally very small houses, because there is a certain numbers you can attain, or you cannot build over the numbers, because when there are too many small houses, it is going to have other effect of traffic congestion, and as well as ingress and outflow and things like that. So like even for specific areas, there must be minimum size. In more congested area, high density, the development requirement is per house must be at least 80 square meters, 100 square meters. So what am I trying to say here is this: Singaporean will have the choice of small, medium, and large based on your budget. If you want bigger houses, you may go for resale. But people in general, just to give you one statistic, in the fourth quarter, as recent as last year, fourth quarter, 51.4% of all the transactions that took place, the size was 500 to 800 square feet. So that's not big, neither is it small. 500 to 800 is the size of anybody who want to visualize a HDB 3-bedroom, which is about 600 to 700. 51.4% of all transactions was within this size. Therefore, I do agree with you. Singaporeans are prepared to trade from our earlier days, the huge size, to an acceptable size that gives lifestyle.
Yes. Family size is also small, only two children on the average, right? Now, let us now turn to our attention to, I think there are lots of people who would like to know what are the growth areas of opportunities. I know Mohammed has given us a good insight into where the property market is going. But what about growth areas of opportunities? Much of the returns in 2020 can be attributed to the growth stocks. With the performance gap between growth and value stocks having widened further in 2020, many of the STI counters and sectors have been and are still associated with value than growth. For one, banks make up 40% of the STI. That said, we have been seeing the rise of technology and growth-related counters such as AEM, Venture, Keppel, DC REIT. Notwithstanding that, they are trading at record high valuations. My question is to both you gentlemen, Benjamin and Seng Boon, what are some attractive growth areas of opportunities for investors? All ears tonight to you both. How can investors reconcile or justify growth with sky-high valuations? Benjamin.
You go first, Ben.
Okay.
I was hoping you'll go first.
We shoot arrow first, me first.
Okay.
Okay, let me just pull out my crystal ball. I guess the very high valuations that we are seeing for technology stocks is simply a kind of an offshoot with what is happening in the S&P 500. So, but you also need to know that a lot of the local counters like AM Venture and of course the Capital Data Center REIT are not exactly in the same space as, of course, Netflix, Amazon, so on and so forth. So I think it's kind of a rubbing off effect on the technology stocks in Singapore. So that's why we've got very high valuation. Some of the overlooked sectors will be, as we alluded to previously, was transportation as well as offshore and marine, because that was, those sectors were badly hit because of the pandemic, and over time they will come back. So energy itself is a very pro growth kind of sector. So as the COVID virus gets tamed down over the months or possibly years, then of course energy prices will inch up, and then people will have to order more oil rigs, and there'll be more maintenance for ships. So that's where companies like Keppel Corp as well as the Sembawang Marine will benefit, but it's gonna take time.
Yeah.
On the other side, you have got very low interest rates in the US. So as you know, Singapore, we don't control interest rates. So which means that, Singapore banks will also have very low interest rates. I'm not quite sure how that is going to impact the net interest margin, because it depends on what part of the cycle we are in. But eventually, I think that could be a plus for the banks as well.
Yeah, I suppose really, as we discussed earlier on, it's really how confident you are to look down the growth cycle. We are at the start of a new growth cycle. So the question is, because this is unlike any other growth cycle previously, primarily because it is still, very wobbly because of the pandemic, even though we are hopeful that vaccine rollout, vaccine efficacy, et cetera, will ultimately stabilize condition, and then we'll see broad-based sustainable recovery. Are we there yet? No. But obviously, it's how far do you want to put a bet on that recovery coming through? Obviously, at this point, you simply ask, are you going to be adventurous enough, brave enough to put your money on airline stocks, for instance? They will come back. The engineering firm, the sector is with us to stay. Singapore is a hub. We need to fly. We will be moving stuff around, whether it's obviously now it's a vaccine. So the point is, when are we going to see, for instance, Singapore used to receive 1.6 million tourists every month. We are down to, well, I think the latest figures I saw, like 14,000, and these are not your tourists, but ultimately they'll come through. So how far ahead in terms of putting money? Obviously, it's far cheaper to so-called take a bet now, but you may be hanging on to that for a little while longer before you see through. So this is where we see, stick with the technology area where there is some proven sexy story, or are you being too early in the growth cycle, the growth stocks, the better one that is still have lingering issues, etc., or you stay with maybe just because of the liquidity in the market, whether you're a trader, in terms of trading, being a day trader. So all these things I think very much matters in terms of what you want to do and how far down the investment cycle you intend to look.
Right. I mean, you choose stocks that are fundamentally sound. These are growth stocks, and you don't worry about the pandemic. You don't worry about what's happening now. You know that what goes down comes up one day.
Yeah.
Sometimes the one day is too soon, sometimes it's longer. But if you know you're picking a well-governed and value stock, you don't need to worry, right, Seng Boon?
Well, that's in theory lah. So we always try to instill that discipline, but sometimes but it is so boring. It's not moving. I need to make money. My friend makes so much. So this is the danger at this point, in which because the market continued to rise after every dip, it becomes buy on dip strategy, and the last 12 months, it suddenly worked very well for that. So this is obviously something that I think Ben and I will be worrying about, in that for now, it looks like you just go with the buy on dip strategy and you can't go wrong with it, and ignore the fundamentals.
Yes.
But obviously, we would still argue that fundamentals still ultimately counts. But you may not be making as much money as somebody who just go with the flow, shall we say.
Yeah, but volatility will be the name of the game for some time.
It probably will. So some of the drivers of the capital markets traditionally has been, earnings, right? Earnings per share.
Yeah.
But now we have got another risk factor, which is the number of vaccinations that have been done, and whether or not we're going to hit herd immunity, so on and so forth. Yeah, new metrics. So I think the current trend of buying on dips is, I guess, is valid simply because we are in that phase of the market where everything seems to be going up based on market sentiment and the promise of the unprecedented stimulus packages, so on and so forth. But again, just to take a page out of history, again, for us old dinosaurs, 12 years ago when the great financial crisis crashed, we would, of course, on hindsight, wish that we have gone out and buy DBS or OCBC, right?
Yes.
And of course, if you're gutsy enough, we would have bought Citibank at $1.
$1, yeah.
$1. Then of course now we'll be rich. So of course I think it alludes to the fact that there are a couple of very big well-known companies in Singapore, blue chips, well capitalized, fundamentally strong, which are relatively cheap, right? And that's something that we can look at. So eventually it would come back, I suppose.
Yes. So we've talked about the stock market, the economy, the stock market. We've talked about the property market. Let's talk about the commodity market. All right. Let's talk about the commodity prices. The focus for business and investors is also commodity prices. Energy prices surged in December 2020, gentlemen, led by a more than 50% increase in oil prices. The World Bank's Pink Sheet reported that. Non-energy prices also jumped 4.7%, with agricultural prices advancing 2.1%, food prices advancing 2.6%. And then all kinds of metals, they're also surged. So with economic activity expected to gain further momentum, my question is, with the expectation from the COVID-19 vaccine, how would such pickup in commodity prices have on the mining and oil and gas stocks? Can we also expect inflation to creep up? Who would go first?
Okay, yes. I'll point at myself first before I point at Benjamin. I suppose it's again coming back to our basic premise that if we are at the start of a new growth cycle, demand should be picking up. Obviously, at this juncture, what is creating a bit more chaos is supply disruption. I mean, we don't have to look too far than look at Singapore itself, where we have, I don't know when's the last time I turned on my aircon, which is good because my utility bills is down. But on the flip side is that we have supply disruption. We have seen, obviously now may not be a good example, because as we're heading into the Chinese New Year, certain items will cost more because of demand, but some has come off. But in general, we have seen, say, food prices much higher now, say 6-year high. But some items are at 10-year high. I mean, palm oil, and many people may not have realized it, but Malaysian palm oil prices are more than a decade high. There is not just an issue of supply disruption, but labor constraint in that because of the pandemic, you don't have enough labor to go out to the plantation. And then recovery story, China is on the far more sustainable broad-based recovery, demand coming through. So that expectation has driven metal prices, anything from copper to iron ore, etc. And obviously, we have seen prices going up. On top of the higher commodity prices, we have seen cost of transportation. Just to transport your goods, say, from China down here or from China to the US or Europe, has also shot up, primarily because there was a shortage of container. We are exporting more, but we are not importing as much. So all the empty boxes are still stuck over in the US side, over in the European side. So cost of renting a box has gone up as well. So all these things are coming through. But the good news is, because we are not seeing a broad-based recovery, what we call negative sort of output gap, in sort of economic jargon is basically we are not consuming as much as what is being produced, so the economy still have slack. So we are seeing, or we are not seeing, businesses passing on the higher cost to you and I as consumer. So if they are not passing it on, they're taking the hit at the margins level. So we have to be careful with those companies that cannot pass on the cost. The good news is the higher commodity costs, etc., are not coming through as much as they would have been in a normal economic cycle. So in that sense, we are not as worried about inflation at this point. Even the Fed, I think, said that they are more willing to see growth broadening and allow a little bit of inflation to run ahead of itself before they will be talking about tightening interest rate, etc., which is from the market standpoint, yay, good news, because we see growth, we see inflation, and we're not seeing higher interest rate. It just seems too good to be true, but that's the situation at this point. So I won't be in a hurry to worry about inflation at any point this year, but perhaps later on this year, if we were to see vaccine rollout be more effective in containing the pandemic, then I worry about inflation. But for now, I'll still say, we watch prices, but I'm not going to be, having sleepless night watching over inflation and risk of monetary tightening.
Yeah, but
I don't know if Ben has anything more to add on
US
that.
dollar, Sengbun, weaker US dollar is a worry. It's very volatile. US dollar is very volatile. And many analysts, I'm sure you have a view on this one. Many analysts and experts predict this will continue to be the case in 2021. All right, now, but they say that they believe the ongoing uncertainty from the coronavirus pandemic, tumbling US economy, and an increase in US dollar money supply will keep US dollar weaker than other currencies. All right, but there are a lot of other influences that could impact US dollar moves and bank forecasts in coming months, right? Will the US dollar continue to remain weak? How will a weak US dollar affect Singapore investors? Moving forward, what are the key influences on the US dollar? What is the outlook for the US dollar against Asian currencies? Let me begin with you again.
Well, so many questions. We can be talking about this the whole night and beyond. I suppose very simply put, is if the US and the US dollar had been any other economy with the scale of the printing that's going on, I mean, there are 20% more US dollar last year than the previous year, and that would have, in that sense, pull the value of the dollar now. But the problem is that on the flip side, dollar is a currency of trade. It is seen as a safe haven in period of uncertainty, which is why maybe perhaps people were worried that maybe there's less safe haven asset around and flood into Bitcoin and cryptocurrency. But that's a separate topic altogether. But if we were to look at the US dollar on fundamental, it should be weaker just because there's a truckload, not just truckload, plane load, shipload, and truckloads of dollar around. And obviously much will really depend on global landscape, if risk remains, ebb and flow, hope and fear turn through. So I think for most analysts, they're looking at long-term, I think, structural weakness of the dollar to continue, but perhaps near-term, we could still see safe haven demand supporting it. But if we were to see against, say, regional currency, we would say that if regional growth here is stronger and we are being anchored by China and therefore seeing more broad-based recovery once we look past the pandemic, which is still a serious problem at this point, then against the US dollar, we should be seeing a more firmer currency here. But obviously, risk reward still would be very, very important in terms of whether dollar stays as a safe haven demand. If there is, then it is hard to sort of topple the dollar in the longer run. But the pressure on the dollar remains just because just too much dollar around, and U.S. economy, U.S. debt issuance, U.S. government debt is piling up. Percent of GDP is still going. Although on the flip side, people point at Japan and say, look, Japan has been, the government has been, issuing tons of debt, and the debt issue is far more serious in Japan. But obviously, we can argue that the Japanese debt are held by Japanese institutions rather than global one. So we can go on this issue, but fundamentally, we'll still say that if the growth cycle is that we are going to see far more sustainable one here in Asia, then we should be seeing firmer currencies here in Asia, and therefore weaker US dollar may help those paying US dollar debt, for instance. So all these things can be beneficial in that sense. I don't see a stronger currency here being a disadvantage in terms of export competitiveness, etc. Because where else are people going to be selling from, if not from Vietnam, Indonesia, China, Malaysia, and around the region? So net, it will still be a flow until such time as our confidence is strong enough that we also start to import more as well. And that we may only see when labor market condition, business condition improve towards the latter part of the year and into 2022. I don't know whether either Muhammad or Ben has more to add on to that.
Well, I think certainly you're right in that there are benefits to being in a country that has got the reserve currency, and obviously the US dollar, and related to that, the US treasuries have always been seen as a safe haven. But again, taking a page out of history, President Nixon was the one that took the US out of the gold standard to fund his Vietnam War and all that. So of course, over the span of 30, 40 years or 50 years, the US dollar has been losing its strength over time, right? I think one thing to kind of take note of is obviously if the US currency becomes too weak, too cheap, then the regional governments may want to kind of tweak the band in which their own local currency trade in, because I could also see that China will get a little bit nervous if the US dollar becomes too cheap, because that will mean that Chinese exports will be relatively more expensive, right? So they do have a kind of a managed float regime, similar to Singapore as well. So, as we all know, US or other currencies are basically a paired trade. So US dollar versus Sing, US dollar versus renminbi. So it's not just about the weakness of the US currency, but also
I think as long as it's on a steady trend rather than a very abrupt, say, appreciation or depreciation, I think allowing businesses to adjust would be ideal.
Yeah, I think it's quite helpful that MAS actually gives indications of what they're trying to do, right? So normally they will give some kind of announcement whether or not.
I think going forward, this is going to be very important, I think, for investors as well. What else to look out for on the currency front, on monetary policy front, in that we do expect and hope central bankers language is something that we're watching out for. To what are they tightening? Are they hinting at tightening? Are they hinting at currency weakness or strength? I think all these things will be signaled well ahead of what's happening. So there will be more order, I think, in the markets, either in the FX market or in the equity market.
Currency investors look up
languages of central bankers, something to be mindful of, even more so in the coming months.
Yes, Mohammed, you confident without the foreign buyers?
I think, David Gerard, I would like to highlight something on the property market. Okay?
Yes.
The fact that we spoke so much, but I think there are many listeners out there, maybe HDB owners, touch on this particular topic. Because I think that there are a million HDB owners, and one of the good news, I must say, is honestly, I think it's a very, very warm welcome news, because HDB property for the first time last year, after almost 7 years, it has gone up by 5%.
Wow.
And the last quarter was the one that it went up by almost 3% to make the 5%. So I think that is important. It's really important that the public housing, because in the last 7 years, especially before 2018, 1, 2, 1, 3, 1, 4, 1, 5, 1, 6, 1, 7, and it has been negative. Can you imagine a million Singapore owners are owning HDB property, but it is not going up, it is coming down. One of the major risks we have here is this. A lot of people, when they go in the older age, when the property lease drop, and if the property prices don't keep going up, when they sell the property, the fact that they have to pay the accrued interest on their CPF to be returned back, and the property price have come down, they barely got enough cash in the older years. That's what I'm saying, that the HDB price increment is a good news. And I'm just hoping that the public housing will keep pace with inflation going about 3 to 4%, and that is necessary. If it go negative and we have to pay accrued interest of 2.6% to CPF, there's no way the equation will come into logic over time. And people can expect the demand for public housing to be strong. And this year we are expecting another growth about 3 to 4% as well.
There you have good news for HDB owners. Finally, the last question from me before we look at whether we have any questions from, those who are watching. China has controlled COVID-19 outbreak much better than US or Europe. Not only is China's economy the only economy in the world to register positive growth in 2020, its economic recovery is expected to strengthen further in 2021, with a forecasted about trend GDP growth rate of 8.2 year on year. How is this expected to improve performance of S-chips, as well as Singapore-listed companies that have large exposures in China? How should investors position their portfolio to take advantage of the continued growth in China? What are the risks that investors should be aware of? Gentlemen?
I point at Ben first.
Yes.
Okay. I guess it really depends on which sector we're talking about. So obviously, the Chinese government is still very wary about the property market in China. So for property developers as well as property-related companies, that will be a risk factor. And also over the decade or so, Chinese regulators also have been, there's a lot of scrutiny on gaming companies, right? So remember when President Xi Jinping first came aboard, there was a lot of scrutiny, a lot of clampdown on gaming companies. So that is also another risk factor. And perhaps the last one is kind of recent. So we do have the aborted IPO of Ant Financial, and that was kind of pulled at the very last minute without a lot of clarification from the regulators. So again, it could be that Beijing is trying to move on the shadow banking, shadow lending, sub-sector in China, or it could be something larger, or maybe it's politics, or I don't know what it is. But the fact that there is not much clarity is kind of disconcerting to international investors outside of China. So those would be some of the
I suppose
factors
to add on
apart
to
from their ability to clamp down on COVID-19.
Adding on to Ben's view, this year is very important for Xi Jinping. This is the 100th year of the centenary celebration of the Chinese Communist Party. And after the pandemic year, they have rebounded. I mean, China registered positive growth. I think China isn't the only one. Vietnam also, but again, Vietnam had 8+% growth, and they still managed to squeak in with a 2% growth, but still good. But I would say that from a political landscape, they are going to be dealing, hopefully, with a less confrontational U.S. administration. They are, celebrating their 100th anniversary for the Chinese Communist Party. So it should be, again, a case of policies ensuring sustained broad-based growth, whether it's in a property market, which is why I think they are looking at to make sure that there is no sort of property speculation is contained, and we see that gradual or even fast recovery on supportive policies. They could be one of the first big major central bank to start to tighten even before the rest of the world, primarily because they may be in a position to be able to do so. So I think condition in China is quite supportive of both the so-called modern services, modern manufacturing, or to the broad-based consumption side, basically because consumer spending would be giving a lift to the Chinese market. So I think we can be looking, at quite a broad base of sectors in China itself. And for those looking to participate, obviously, via Hong Kong has been one of the primary conduit. Less so for us over here, but obviously for us who are seeing businesses in Hong Kong, or in China itself, I think that broad-based lift from consumption recovery should be supportive of their business in an environment where I would say you get, I think, fairly supportive fiscal policies to remain monetary, essentially sustained recovery in the Chinese economy to continue into this year.
Okay, gentlemen, I've got two questions coming from listeners. What's Mohammed? What's your view whether government would take additional cooling measures, and what sort of measures would they be? Are you expecting? You said that there isn't foreign investment. They're all Singaporeans, but Singaporeans are worried because prices have been going up, and there's been a flurry of activities and announcements made by government. We are looking at you very carefully, Mohammed. So
he's putting you on the
now
spot.
we point at Muhammad in terms of
putting you under pressure.
No,
So,
no.
yeah, tell us.
I think it's a very valid question. I think developers are concerned if there's another round of measures being announced, and every measures there will be a pullback effect, at least for a period of time, because it is only right thing people trying to understand the outcome or the effect of a cooling measures. I'm quite certain. I'm not expecting, this is personal, I cannot qualify that.
Yeah.
In my opinion, I'm not expecting a cooling measure next month.
No.
Or the following month. I am not. However,
Yeah.
I am not ruling out a cooling measure, if at all. What will be the indicator for a cooling measure?
Yeah.
I would say what is the government is concerned about is non-sustainable growth.
Right.
If you go back to just the last cooling measures was announced on 5th July 2018.
Yes.
What triggered that was the first 6 months of 2018 had a growth of 7.9% in 6 months. Therefore, the telltale signs were the whole year, it is definitely going to be a double-digit growth in 2018. For that matter, the government, if you look back before they announced on 5th July, if you go back the 12 months backward, it was 9%. Therefore, what the ministers are saying that they're keeping an eagle eye here is this: I want to make sure property prices go up that are sustainable. Therefore, if in the last quarter we had a 2.1% growth, I'm saying that the real estate market went up by 2.1% the last quarter. The whole of last year, it only has gone up by 2.2.
Right.
Therefore,
Right.
the indication will be the first quarter when it is announced in April. If it goes up by another 3%, there are alarm bells to be concerned about. Because in the fourth quarter, it went by 2.1. And if the first quarter go by 3%, we already have in 2 quarters, it crossed the 5% mark. Is this sustainable for another 2 more quarters? Then there is a likelihood any cooling measure may be announced in the second quarter or thereafter, basing on this. And again, what are the measures the government can do? Very easy calibration of existing levers. Obviously, here is this loan to value. They can increase the cash outlay of an individuals that if you want to buy a property, giving you lesser amount of loan so that there's greater prudence. That will definitely create a market that is many people may not be able to buy. Obviously, the other levers will always be people who are buying a second and third property to increase the ABSD. Or for that matter, even the seller stamp duty, which used to be 4 years, have been reduced to 3 years. It could again be increased to 4 or 5 years. I mean, you really come and buy with a long-term view and not speculations. So these are all the various options the government always have, and therefore it is while the ministers are looking at it, it is also good every one of us individually look at it before we enter the market so that we can ride through the crisis.
Okay.
Another point I want to add is what else am I watching for apart from the prices is the en bloc market. Whether we see fever coming back to the en bloc. I'm starting to sense people are getting excited also in terms of en bloc. If that's too exciting or too hot, that's something else I'm watching out for as well.
Okay, en bloc, yes, it's an opportunity of a lifetime for many. Benjamin, U.S. stocks, have they gone through the roof? They are trading too high. Would there be a correction? What about SG stocks? Are they manageable, or are they beyond, ordinary investors' reach?
Sure. So for the US market, there seems to be a bifurcation between different K-shaped recovery when some sectors do better than others is, I guess, manifesting itself. Even within the technology sector, there is a split between a bunch of companies. For example, Apple has already reached its consensus target price, while Amazon still is languishing about 10% or 15% down its target price. Netflix has done very well simply on the back of the news that they've hit 200 million subscribers. So it really depends on the individual company that you're talking about. And actually this week as well as next week is very exciting news, because today is the 27th of January. Apple and Facebook are releasing their earnings today, US time, probably after the market closes. And tomorrow will be MasterCard and Visa. Next week, I think it's Amazon. So this will be the couple of companies which probably investors want to look at.
You expect good news from these two companies?
Well, I am personally invested in Amazon, so this is not a personal endorsement, but hopefully, but I'm guessing that Amazon will probably do well. I mean, Microsoft did well,
He's
so on and
doing
so
well,
forth.
yes.
Yeah, so
all the big tech companies who have announced have done, whether you're talking about Microsoft or Texas Instrument, even consumer Johnson & Johnson, they beat expectation. So I suppose there's a lot riding on this current reporting season.
Yes.
So, yeah.
I mean, I've got money, and let's say I want to buy. I'm a first-time home buyer. I'm looking for not an HDB, but I'm looking for a condominium. Do I hold back money and wait for cooling measures, or do I go in now? I don't want to put you on the spot.
The same question can be applied to stock markets, right? Should I wait for the dip? Should I wait for the correction to buy? Yes.
Correct.
Yeah.
Buy on dips, yes.
What do you think?
I mean, if you ask me from a property perspective, one would never be able to time the market.
Yes.
That's the truth of the matter. And I always say that anybody who wants to buy a property really look at mid and a long term. And I define the mid and a long term being 5 years and beyond. As long as you're buying a property, having that safety net in the event of a crisis, you can still pay the mortgages for the next 5 years, and you can hold on to the property. You're very likely to ride out any crisis over a period of 5 years. So I still think prudence is important. Buying within means is important, not to be speculative. And Singapore being definitely land scarce, property prices over time keeping pace with inflation, there's still a very likelihood of just moving upward.
Thank you, gentlemen. We've got a lot of guidance and advice tonight. Final word of advice, Sengwoon.
Oh, I suppose stay within your own comfort zone in terms of investment, in terms of if you are not comfortable and not familiar with something, stay away with it, which is why I haven't earned any money from Bitcoin or Tesla, because that's still continued, right? You have to gravity. Stick with what you know and learn along the way.
And Ben,
still will be a bumpy ride.
Bumpy ride, yes. Ben?
Well, just continuing on with the theme of choppiness in the market, I think investors have to be patient, right? So even from a personal investing perspective, earlier this year I bought into Apple and Amazon and some of these technology stocks, and initially didn't make money, but when the market corrected and it went up again, I made something. So just be patient, find a fundamentally strong company, and just put in a small amount of money at risk, and just diversify it. So I think that should be the way for the medium to long term.
Since HDB prices went up, good time for upgrading.
Wait for further increase.
My just little advice or to consider will be to say that actually this is indeed a buyer's market. We already said the huge thing is not to the developer's advantage or the economy or the outlook. And it is also in a low interest rate environment. As long as you have done your sums right, this may be a good time to reorganize your portfolio if you want to laterally move to a property that with a longer lease. Because some of us, you see, one of the best things is to not to do anything. You feel safe. But not doing anything, and if your leases keep dropping, or if you're not just preserving the value, is also not the right thing. But I also agree with Mr. Song and so on. Don't do things you are not really familiar with. Get the knowledge. buy within your means, and it is indeed a buyer's market, it may well allow you to reorganize your portfolio to the right way that you want to hold for the long term.
Well, I hope listeners have got what they were hoping to get tonight. We have had the real experts talking tonight to you. Thank you, Song Seng Boon, for sharing your valuable time with us. I know you're away from your family. Go and have your good dinner and a beer. Benjamin,
Definitely.
thank you. Thank you so much. And Mohammed, indeed, a great analysis of the property market. God bless you all. Good night.
Good night.
Thank you very
so
much.
Yep, same to you.